Let's take a look at the 4 types of life insurance policies that you can have. The first policy is a term policy. Easily reminds you as it terminates. This policy lasts for a specified time frame, 10, 15, 20, 30 years. Usually good to cover a mortgage or something if you want to get coverage on yourself, God forbid you pass away too soon. It's the cheapest policy, right? If you want $1 million policy for like $50 or $100, again, it's depending on your age, health, and gender, but that's going to be the cheapest for the most amount of coverage because the goal is for you to outlive the policy and not actually pay out. But if you pass away too soon, your family is protected and it pays out. Purpose of the policy. Great policy to have when you're like 25, 30, 35, 40, 45, and you want to cover a large amount and you have a limited budget. The second policy is going to be a final expense policy. This is a whole life policy, but it's only there to really cover final expenses, burial expenses and stuff of that nature. These policies typically range anywhere from $5,000 to upwards of maybe $50,000 on the high end. This is usually going to be for somebody who didn't prepare in life and they don't have a large set of money to pay for the burial expenses. This is going to be somebody usually 55, 60, 65, 70 that just don't want to leave that burden on their family. And again, you are going to be paying a pretty penny for the coverage amount in volume, but it's because your age, your health, your gender, and you waited too long. You don't really have the finances to cover burial. So great for somebody who's 60 to 70 years old and needs coverage, right? A whole life policy, okay? So yes, like this is a whole life policy, but this whole life policy is what you hear people talk about on social media. This is a cash value whole life policy. This is going to be with a mutual company that gets dividend returns. So this is where people overfund a policy in accordance to very specific tax codes to get returns via dividends from a mutual company. These will average usually around 5% per year. Don't quote me on that. It's not guaranteed. It's dependent on the company that you're with and the dividends that they receive. But typical return in this is going to be a 5% growth in your account value that you can leverage against under loan provisions throughout your life. So people will use this to privatize and protect money, to use for business ownership, and just to also protect their family. But that's a whole life with dividend returns. Jumping down here to my personal favorite is an IUL. Again, I like them all. They're all for specific scenarios, but IULs are indexed universal life insurance policies. This is an index-linked crediting strategy. So what that means is you overfund these accounts following the very specific tax code, right, 7702. You put your funds in this account. It's linked to an index such as the S&P 500, and you're credited on an annual basis. These can range anywhere between 5 to 12% on average per year. So let's say around conservatively, the average about 8% rate of return comes back to your account based off of your account value each and every year. As your account grows, you can access cash from your account. You access a loan. You borrow in the form of loans because the loans are tax-free. You borrow money from the insurance company, and then when you pass away, the insurance company just deducts it from what pays out from your account value or your death benefit. But that's an indexed universal life policy. So these are the 4 different types. Term is going to be the cheapest. Final expense is going to be for somebody who's just pretty much ill-prepared in life and they're like 55, 60, 65, and they don't have enough money for burial expenses, but they want coverage. Whole life with dividend returns is usually going to be a business-based company, somebody who wants to put money in, access liquidity pretty quick, or they want to do a certain paid frame. Really, as someone who wants dividend returns instead of index strategies, in dividend returns usually 5%, index strategy usually 6 to 10. But when markets go negative, you're floored at like 0. That's the difference there. You usually it's just quote unquote. I don't even want to say it's more guaranteed, but it's not really. And then index universal life is somebody looking to set up a tax-free retirement account or something long-term, play the long game, and they want to set this up to use in the later years for supplemental retirement income and or to just protect their family and get good returns.